Dino, so Powell's talking about possibly cutting rates. And my question to you is, if the Fed cuts their rates, do we think mortgage rates are going to go up again like they did last September, or do you think they might come down?
I have no idea.
Rates are down today.
It doesn't matter because let me explain why. If anyone can predict that, it's insane.
Right.
Because okay, first and foremost, Powell is cutting the shortest of short-term rates, right? This is what he's cutting, Fed funds, right? What does that mean? That's an overnight rate. It is, okay, you look at a spectrum of different things that determine rates. It is the shortest one. It's overnight, right? Then you got like 30, whatever. Now, all the way up to a 30-year mortgage, right? That's long rates, right? Now, short rates, long rates, are they, they can be, proportionally related or inversely related. It all depends. The key thing here is the long-term interest rates, which is what you care about on mortgages, right? It's a 10-year treasury. That is the basic index for all mortgages, 10-year treasury, right? That is determined by the bond market. Now, again, I don't have any empirical evidence to support this. Is my opinion, and which I derive from a lot of other people who it's also their opinion. Why it went up the last time? Because there was a lack of confidence in the future growth potential or the future, the future of the U.S. economy, right? So we're not going to do well in the future. People sell off our bonds because they don't want to hold our bonds for a long term if we're going to go into the tank in the economy, right?
Right.
Then rates will all go up and their bonds will be worth less, right? So in this case, I have no idea which way the bond market's going to go based on the Fed funds. Yes, you can make a case, but again, everyone can make this case, but is it factual? Who knows? You gotta, you can't armchair quarterback this. You don't know because it's prediction.
Right.
You don't know,
you can't
right?
Say yes or
if
no.
you lower the rates, how's it going to impact the economy? How's it going to impact the economy? Is it going to help jobs? Is it going to help growth? Now, if lower short rates right now impacts, the economy positively, whether it be the creation of jobs, lower cost of like small cap companies have cheaper debt, they can do all these things. If it stimulates a job market, it stimulates GDP, then your economy is stronger, then the likelihood is the bond market will not sell up. People are going to go long the bond market now because they think we're going to be stronger next time and rates drop, right? So you want to take advantage of buying, long-term treasuries right now at a higher yield, right? But if this rate cut happens and the data shows or the market sentiment shows that we're going to be weaker, then guess what? The bonds will sell off and the long-term rates go up. So you don't know. You don't know.
Nobody knows.
I mean, that's what I think. No one knows. Everyone, all the greatest economists out there and all that, everyone has their predictions. Yes, you can say one way or the other, but the reality is you don't know because prediction is extremely difficult, especially if it's about the future.